is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London, and here's what's coming up on today's programme. The Fed's Beige Book suggests the US economy stalled in recent weeks as access to credit tightened. The mood is now firmly risk-off with Europe in the red. US Speaker Kevin McCarthy proposes a $1.5 trillion increase in the debt ceiling as fears grow that falling tax revenues could hasten the date of a potential default. Plus, Tesla slumps 6% post-market. That's as Elon Musk signals deeper price cuts despite the squeeze on margins. We bring you the pre-market share price in just a moment. And TSMC beats on net income, but forecasts worse than expected second quarter sales on fading demand. Let's check in on these markets then. As we said, firmly risk off. You're seeing that pronounced as well in terms of the futures in the US. You have a move into bonds. Yields are coming off across the curve. Commodities significantly under pressure as well around those recession risks. The Fed Beige Book flagging a stalling US economy. John Williams of the Fed saying that credit conditions are starting to tighten, but still saying more work needs to be done on the inflation front, and earnings not doing enough to convince these markets that corporates have the resiliency, at least for now, to weather a recessionary environment, with the caveat that it's still early days on the earnings front. Across the benchmark in Europe, you're seeing losses of 0.3%, 4.2 on the 2-year. That's a move lower by a little over 3 basis points. Euro dollar at 109, with people like Jeremy Stretch, calling for potentially 115 on euro dollar in the weeks and months ahead. Brent currently at $81 a barrel. That's a move lower by 2%. Look at that. Brent under pressure, squeezed again on those recession risks. Look at that picture on the map. Flashing red again as investors adjust to a slowing US economy, but with central banks still coming out and saying more work needs to be done to get rates higher and inflation down. And then, of course, you have to weigh up the risks around the default and the prospects that the clock is ticking on that in the US. US Speaker Kevin McCarthy proposing a bill that would raise the US debt limit for about a year and cut federal spending. Let's get the details then with Bloomberg's Bruce Einhorn. Bruce, how does this change the prospects then for this slowdown, this showdown in terms of the debt limit, how the two parties are squaring off, and how much risk now has to be factored in by these markets?
Well, Tom, Speaker McCarthy has said that the plan would be, as you said, to raise the debt ceiling until sometime next year, to have about $130 billion worth of cuts in discretionary spending. There would also be a limit on additional spending going forward. A couple of big question marks here, though. First of all, President Biden has adamantly opposed the idea of conflating negotiations over the budget with the debt ceiling. He says that the debt ceiling needs to be raised clean. After that, there can be discussions about the budget. He's also said the Republicans need to come forward with a specific budget proposal. So far, Speaker McCarthy has said, here's what we want to cut this amount, but he hasn't said where the cuts come from. That's where things potentially get very difficult. On the Republican side, McCarthy only has a pretty small majority. He can't afford to lose many votes. There are some Republicans on the more conservative side of his caucus who are adamantly opposed to raising the debt ceiling, who are opposed to the idea of any sort of return to even 2022 spending levels. On the other side, there are a lot of Republicans. In fact, the Republican majority really depends on Republicans who represent Biden districts. These are districts that President Biden won in the 2020 election, but Republicans flipped in the 2022 midterms. A lot of those Republicans are going to be very wary about pushing ahead with votes that could become very unpopular in 2024. So it's not even clear that Speaker McCarthy has the votes to get this through the House. That said, he has indicated that he'll be bringing this up to a vote possibly as early as next week. Even if it does clear the House, it doesn't have any chance in the Senate. So ultimately, there's not going to be a solution at the congressional level. It's going to have to be between the Republicans and President Biden. OK, Bloomberg's Bruce Einhorn on the opening gambit from the Republicans around
this debt ceiling and the potential risks of a default in the US. Let's check in on Tesla, really one of the leading corporate stories of the day, of course, after those earnings, and particularly the commentary from Elon Musk and his chief financial officer around margins and their willingness to squeeze those margins further to build out and maintain market share. Pre-market then, you're seeing a knock of almost 7% to Tesla's share price. Again, margins coming in to 11.4%, down from 19%. A drop of 19% down to 11.4% for Tesla's margins. But here's the context, and here's what they stressed over at Tesla. Ford at 4%, GM at 6.6% in terms of margins. Tesla still has a healthy lead on margins. They are prepared to cut prices further, was the messaging, because they've got that margin buffer and they want to continue to carve out market share. Competition across the auto space as a result of that. There's the stock down 7% now on the back of the margin story out of Tesla. Now, the US economy has stalled in recent weeks with hiring slowing and access to credit narrowing. That is according to the Fed's Beige Book. It marks a step down from the tone of the previous report out in March, just before, of course, the SVB, Silicon Valley Bank collapse, which showed a resilient economy. The Beige Book likely reinforces the chances of a pause after a likely 25 basis point hike in May. Let's bring in Christine Aquino, Managing Editor for Bloomberg Markets today. Christine, thank you for joining us in the studio. Your take on the Beige Book then, the market reaction, risk off today, reassessing the recession risks.
Well, Tom, I think this is in some ways what the Fed was hoping / expecting after more than a year of a series of rate hikes, right? It is that slowing of the credit flow into the real economy. And the consequence of that is, yes, some businesses might not be able to have as easy access to credit as they once did, especially if their financials aren't looking all that great. And so this is all consistent with a mild recession expectation from Fed staff economists that we saw from the last March minutes. But then how this kind of translates into perhaps a bigger problem and a harder landing than the Fed expects is via the jobs market, for instance, because as we know, a lack of access to credit for businesses, that could become a real problem, especially for some of them that employ a lot of people. And so if this credit crunch, turns more painful, then that could translate into mass layoffs, and what was once potentially just a mild recession could easily turn into something much bigger.
The real importance around focusing on those credit conditions and whether they turn indeed into a severe credit crunch. The importance, of course, for the corporate sector and households. Christine Aquino, thank you very much indeed on the Fed Beige Book and how markets are interpreting all of this. Let's get the Bloomberg First Word News now with Leanne Gerrans. Leanne.
Tom, good morning. Turkey is set to start natural gas production from the biggest field in the Black Sea today. State-run producer Turkish Petroleum says that Sakarya field will initially supply 10 million cubic meters per day. The news source gives President Erdogan an opportunity to slash energy prices less than a month ahead of key elections. By 2028, the field is slated to be producing enough gas to cover 3/4 of Turkish consumption. Now, Chinese banks have kept their benchmark lending rate unchanged after the country's central bank held back from easing monetary policy. The People's Bank of China maintained its one-year loan prime rate at 3.65% for the 8th straight month as the economy continues its recovery. Now, Elon Musk has signaled that Tesla is not done cutting prices after the company missed first quarter profit estimates. Shares in the EV car maker dropped in after-hours trade after the CEO argued there are good reasons for more price reductions. The base price of the Model 3 has now dipped below $40,000 over in the US for the first time in years. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Tom.
Leanne, thank you. Coming up, we're going to be joined by Florian Toncar, Germany's Deputy Finance Minister. We're going to discuss the banking crisis, the fallout, and the European economy's outlook. A really important interview. That is next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Tom Mackenzie in London. Now, the past quarter has seen 3 regional US lenders collapse, if anyone needs reminding of that. But Wall Street majors, well, they have raked in gains with little sign of strain hitting the sector. Over in Europe, the spillover ended up in, of course, in a forced marriage of Swiss giants UBS and Credit Suisse. Investors now, in terms of their fears, hit Deutsche Bank. Those investor fears did hit Deutsche Bank, with prices for insurance on its bonds temporarily shooting up before coming down again. For more on all of this, let's go to Berlin. Oliver Crook is standing by and is joined by a really important guest who can give us a sense of the health of the German and European banking sector. Ollie.
That's right, Tom. Thank you so much. We're joined by Florian Toncar. He is a member of the FDP. He is also a deputy finance minister here in Germany, in charge of financial regulation, in charge of financial markets and banking. So a very interesting and timely conversation. Thank you so much for joining us. Let's begin perhaps predictably on banking and market stability. Germany emerged relatively unscathed from the sort of chaos we saw in Switzerland and in the aftermath of SVB. What did this episode teach us about the nature of risk and how it's changed for the banking sector?
Well, first of all, I don't think it's surprising that when you have two extreme situations in a very short time, the pandemic and then the extreme inflation, the sharp rise of the inflation throughout the world, that, of course, this has impact on the financial markets, and that the reaction of the central banks has immediate impact on financing conditions of banks and corporates. So it's not surprising that there are particular specific market participants which come under stress in such a situation. For us, it is very important to make sure that the overall system works, is stable. And I think we have properly ensured that through macroeconomic measures, we have required additional capital buffers for banks 1 year ago, clearly communicated. And we are, of course, alert. We know that we have to observe the market closely, but we don't have reason to believe that there is an immediate risk to financial stability.
And I think one of the things that made this crisis stand out from the others is the speed at which these things happened. And obviously, Deutsche Bank came under the crosshairs of investors for a day or two. There were some very big moves. It's obviously recovered all of that. But how did you view that move against Deutsche Bank, and how do you prevent that from happening?
Well, it was happening after the 81 bonds at Credit Suisse had been written down. And that, of course, caused some form of turbulence where equity for banks was repriced throughout the market. I think it teaches me that we have to point more to fundamental data of banks, which were well at that time and are continuing to be fairly well. So fundamental data have an importance, and that, I think, is what we must point at. And we must make clear that we have robust capital requirements. We will even increase capital requirements by the Basel implementation this year. And we have a robust crisis management, which we will further work on in Europe to make the authorities able to react swiftly and appropriately.
And as someone in charge of all of these sorts of things, how do you feel about how Switzerland resolved the issue with Credit Suisse?
Switzerland was under high pressure, of course. That was a global issue. And they, in effect, found a solution over almost only a weekend, which proved to be successful in the end and in effect. Therefore, I have high respect to what the politics, what the regulators in Switzerland have achieved. Of course, we must also point out in Europe the succession of how we would hold equity holders liable would be different. We would start with the direct shareholders, and only then would continue with the 81 bondholders. That would be the succession, the order in Europe. But that's one difference. In overall, the authorities in Switzerland have done a good job on that.
And obviously, another consequence of this crisis is that Switzerland now has a monster bank. Does Germany need a monster bank to compete on the international stage?
It is not for the government to comment on particular. Is it
something you'd like to see?
No, I think we need banks which are competitive. We need banks which are stable. We need banks which are profitable and successful. And size is not an issue or an asset as such. Quite the opposite, of course. Size also increases systemic risk, and therefore any solution which increases the size of banks requires particularly close attention of the regulators.
And Mr. Lindner this week talked about the soundness of the German banking sector, but he had also mentioned that some of the risk has migrated from those institutions into shadow banking. What exactly are we talking about, and how do you regulate, how do you address those risks?
This is absolutely valid point. We need to look into the non-bank part of the financial market, the so-called shadow banking sector. Because there, for instance, funds are extending loans, are extending credits in some segments of the market, have a high market share on that. And of course, they also collect money from funds from investors, which can be safer or less safe, depending on how the liquidity management, how the governance of such a fund is. So the European regulator will be well advised to deeper look into the liquidity management, the stability also of funds of various sorts.
And I want to talk about the economy more broadly. So the recession fears have sort of eased up, but there are still obviously quite tight credit conditions here in Europe, and they're tightening and tightening. What's the risk to the German economy there, and how do you deal with that?
Well, it's a direct consequence, of course, of the very clear reaction by the central banks on inflation, which is necessary, which will continue to be the focus of the central banks rightly. The sooner we get inflation under control, the better for the economy, for the economic recovery. The longer, the more stickier the inflation is, the more disadvantage. So we support that. For the politics, for the German government, the consequence is now that we indeed need to complement the restrictive monetary policy also by a more cautious fiscal policy, no more debt, consolidation of the budget, reduction of the debt rate to GDP. Yeah. And that in consequence means that we need to create economic stimulus without fiscal implications. So this is less bureaucracy, quicker planning procedures, addressing the issue of skilled workforce in Germany. Yeah. These are the factors which are relevant now.
And these are all connected to this idea that we've been talking a lot about in Europe, which is securing supply chains, which is also a euphemism for deglobalization, right? And this costs a lot of money. The United States has the Inflation Reduction Act. China's obviously been aggressive in the support of its companies and industries. Do you think that Germany needs to do more, and will it have to spend more money to achieve these aims?
Well, this is absolutely, it's a process which is already ongoing. I don't speak about deglobalization. We haven't seen any deglobalization over the last months or years, but a long-term trend is a slowdown of the speed of further globalization. But it's not going down, by the way. But we need diversification. We need various supply sources for critical minerals and for critical components. And of course, we will build up also a microelectronics industry in Europe, a battery, key components for future growth of our economy.
Florian Toncar, Deputy Finance Minister of Germany, thank you so much for joining us. Back to you, Tom.
Oliver Crick, really fascinating interview. Thank you very much indeed. Joining us, of course, Anna Berlin with Germany's Deputy Finance Minister. Coming up, not looking chipper, TSMC's revenue outlook disappoints as the global tech slump continues. We'll get the latest next. This is Bloomberg. Welcome back. We're going to bring you live pictures. We are bringing you live pictures from Ireland and the inaugural Bloomberg New Economy Gateway Europe event. Bloomberg anchor Francine Lacqua is speaking with Lord Kim Darroch, former British ambassador to the United States, also joined by former president of Croatia in a discussion about Europe's role in an increasingly fractured world. We're going to hear from more newsmakers at the event throughout the day, including panel discussions with the Irish Taoiseach Leo Varadkar and BlackRock's Vice Chairman Philip Hildebrand, as well as Ireland's Finance Minister Michael McGrath. That is all on Bloomberg TV and for terminal users at Live Go. Let's go back to one of the big corporate stories of the moment. Pre-market checking in on Tesla taking a hit after Elon Musk and the CFO reiterated their determination to continue to build out market share even at the cost of what were once very healthy margins. Down 8% more than 8% on the back of that news as investors digest the commentary and the earnings coming through from Tesla. Don't forget their German factory and their US factory coming online as well, their Texas factory, I should say. And in terms of the margins, the context is they've gone down from 19% margins to 11.4%, so a huge drop. But the other part of that equation is that their rivals, if you look at Ford, they have margins of just 4%. GMM, General Motors, have margins of just 6.6%. So Tesla think they have room to go, that they have that buffer, and that they continue to push price cuts. That's what they think, to cut the margin and build out that market share. But of course, investors are not happy with that scenario. Checking on some of the individual stories, you've got Renault, L'Oreal and Nokia. The earnings really not doing enough to support what is happening across the equities picture in the session today. Down 0.3% across the benchmark here in Europe. Futures pointing lower in the US, down 0.7%. L'Oreal is the one that remains in the green, up 0.5% in terms of the beat on earnings. Renault taking a hit, concerns about pricing there as well, currently down 6.4%. Nokia also coming in with a miss on its earnings. The telecoms infrastructure company down 3%. Coming up, surprise after surprise on the data front this week. Bloomberg UK will look at what the BOE is contending with. This is Bloomberg. Good morning and welcome to Bloomberg UK. I'm Tom Mackenzie in London. This week we focus on the UK's inflation problem and the headache it poses for the Bank of England and number 10 Downing Street. The latest UK inflation print has surprised to the upside. CPI in the year to March stayed in the double-digit range again at 10.1%. Wage growth for February also came in hotter than economists' expectations. Now, the pressure is on at the Bank of England. Policymakers, led by Governor Andrew Bailey, had previously expected both pay growth and inflation to cool. Bloomberg Economics has also scrapped its pause forecast. Our team now sees a 25 basis point hike at the next BOE meeting on May the 11th. With the data hotter than forecast, interest rate traders are also now converging on a terminal rate at around 4.85%, close to that 5% level. And a terminal rate of 5% is very much within the realm of possibility. So let's take a deeper dive into what the latest data means for policymakers at the central bank, in terms of politics as well, and bring in Anna Andrade, Bloomberg Economics' Europe economist, and Bloomberg MLive cross-asset strategist, Ven Ram. Good morning to you both. Thanks for coming in and joining on this discussion. Anna, let's start with you then. What is happening with UK inflation? We're the outlier now. I'm thinking of Europe, a little under 7% in terms of CPI. The US at 5%. We're at 10.1%. What is going on?
OK, so just two different things with the data. The first one is that it essentially suggests that underlying cost pressure is much stronger than we anticipated. That's something we just have to recognize, and that was also reflected in the pay data. The comparison with the euro area and with the US, I don't think it's super fair. Well, with the US, just because it didn't face this massive energy shock that the UK still and Europe faced. And also with the Eurozone, in March, the Eurozone benefit from energy base effects. So this kind of effects that will mechanically bring down inflation in the UK, and that we will only feel them in April because of the off-gem cap. So that kind of explains a bit, you know, some divergence trends. OK,
you don't think it's fair. There's the terminal chart showing where the UK lies versus its colleagues in Europe, in terms of the CPI, of course, and the US as well. So we are the outlier, but you're pointing to some important differences there. Anna, what is the Brexit effect on UK inflation?
So right now, I mean, so there's no doubt, and we've put some research out there saying that Brexit will have an impact on the economy. That's kind of clear in GDP and in investment numbers. But in respect to inflation, we just don't have enough information to say that it's Brexit. And I'll just add two things. One is on food. If you do look at food, the sort of surprises that you got in food inflation in the Eurozone and in the UK have been broadly the same throughout, 2022 and in the latest data releases. The second is core goods. And there could be not sure if a bit of Brexit effect, but there you do see some signs of strong corporate pricing power, and that can make inflation more persistent. The BOE is worried about that. Whether it's due to Brexit or not, we cannot really tell. But so far in the data, there's just no obvious signs that it's...
OK, from Brexit to breakfast, because we have the breakfast index, and we see the gauge has gone up, what, 23% on a yearly basis. Of course, talking about the staples of every English home's breakfast. I mean, that is a complete stereotype. But nonetheless, sausages, bacon, mushrooms, baked beans, tea and coffee, all up collectively as a basket, about 23% year to date. Those gains are coming through. That is essential in terms of the inflation picture in the UK. Are we getting a sense, Anna, that those prices are anywhere near peaking?
It's a bit, there's some uncertainty there just because, producer prices for food kind of pointed to a downward trend, and that's just not been reflected. That was also the story in the Eurozone. So there's a bit of a question mark there. But I would say that we got more surprised on the CPI data. We got more surprised on the core inflation, which is the most problematic bit. So both services and core goods were actually stronger. And I think that's kind of where the BOE will be concerned about.
OK, so they're concerned more about core than necessarily what's happening in food prices. Venram, let's bring you in. At this point, you've been pretty prescient in terms of your calls on UK asset prices as a result of the inflationary inputs coming through. Is it your assessment now that we're right to be pricing in close to 5% from the BOE?
I think we're absolutely right to be pricing in 5%. If you look at the real rate curve in the UK, Tom, we are doing just about 30 basis points on the one-year tenor. And this perhaps needs to move up to at least 1% for the tightening to bite. And what will cause that shift from 30 basis points to 1% on the real rate curve? You need a big move up in the nominal rate curve, so which means that 5% on the nominal benchmark rate from the BOE may indeed be required. If you look further out the real rate curve, it's also inverted. The key parts of the curve, the 5-year and the 10-year part of the curve are inverted. So basically, they're at zero now, and those need to push higher as well for the tightening to bite. So net-net, we are indeed looking at a terminal rate around 5% for sure.
Wow, a terminal rate of around 5%. I just wondered to what extent investors have adjusted to that. In fact, households as well, as they look at their mortgages, Venram. I'm looking at the front end then, 380 on the 2-year, and you've been discussing and pointing to that bear flattening that we've seen. 380 on the 2-year, 382 on the 10-year. Then what does this mean? The ride-up in gilt yields, it's not happening today, but we saw a significant ride-up yesterday. And the views on 5% terminal rate, what does that mean for pound strength coming through in the weeks and months ahead?
Well, the pound has come back more than 20% from its lows last year. And we have known for a long time now that the UK economy is likely to slow this year. So in other words, the pound is doing something different to what the economy is doing. So there is something driving the pound despite the gloom and doom. And what is that factor? That factor is the dollar weakness, broad dollar weakness, stemming from the fact that the Fed is approaching the end of its tightening cycle. In such a scenario, the euro will be bid and the pound will outperform the euro. And this is the key thing that the markets have been missing. And I've been saying this from the start of the year, the pound is going to rally, and it's doing a 125 thereabouts now. But I do think that it's definitely got more upside in the months to come.
Yeah, you were the contrarian at the beginning of this year, Venram, with that call for stronger pound. 124, as you say, close to 125 on pound dollar. You had the view from Jeremy Stretch earlier, you get to 126. He's not really buying the view that you get 130 on the pound. Where do you think it ultimately tops out? Do you have a view on the next level?
I do think that 130 is definitely doable for sterling, particularly later in the year. I think what the markets are waiting for is confirmation that the Fed is going to stop. And if the Fed starts cutting rates, as the markets are speculating they will by the end of the year, I think that the dollar has big downside. That will push up the euro and that will push up sterling definitely towards 130 levels.
OK, Anna, if you align with the view from Venram that you get to potentially 5% on the terminal rate, but if you do, as a proposition, what do you think that does to the UK economy?
Yeah, so I think if we do get there, it's because the BOE sees that the underlying cost pressure in the economy is so strong and that there's some sort of inflation, the inflation psychology has changed, that it needs to take rates that higher because internal...
Sounds like you're sceptical.
Well, internal research from the BOE has pushed back on that terminal rate before in the trust period. And there's also internal research saying that at 5%, that's really when households' resilience starts to be tested. So I think that, I do see like the risks of 4.7 4.75 are like 4.75 is very plausible, but the bar to get to 5% is just a bit higher. Not impossible, but just a bit higher.
What does it mean for the housing market? It's already under pressure. Is the housing market able to slow without completely cracking?
Yeah, I mean, the important thing is really what we'll do to the economy. So right now, our call is for the UK that will dodge a recession. You know, we see the UK growing by 0.1% this year. The question is, if you take rates that higher, then you know, the second half of this year won't look as good, and neither will, you know, the start of next year. So there we will potentially be looking at the recession there.
There's been a bit of head scratching from some people around the strength of the UK consumer, despite this cost of living crisis, historic cost of living crisis. Does that resilience, do you think, hold up into the second half?
Well, part of that resilience was probably driven by the fiscal support that we saw last year, and also the labor market strength that we've seen since the start of the year. I mean, last year we were probably expecting the labor market to be cooling much faster in this period than we are actually seeing. And we are now forecasting the unemployment rate to remain unchanged until the mid of this year. So this is, you know, strong wage growth, all of this recovering confidence that you are seeing in the confidence indicators. This is kind of propping up consumer. But once the labor market starts to tighten, you know, policy rates have kicked in, but they've not fully kicked in into the economy. Once that starts to happen, then the labor market will cool, and then, you know, maybe this consumer strength will be a bit weakened.
A cooler labour market, wage growth is accelerating, but still on real terms, of course, in negative territory. Does it pull more workers into the workforce? Does it address some of those participation concerns that we have around UK labour force?
Yeah, well, forecasting participation has been, you know, tough over the past months, just because we've been kind of constantly surprised with how tight the labor supply has remained. But it's true that in the latest data, we have been seeing kind of people coming back to work. So right now, I think we have 170,000 workers missing compared to the pre-pandemic. This was close to 500,000 in the middle of last year. So there's a trend that, you know, kind of suggests that, you know, the real income squeeze is starting to bite, and people kind of need to go back to work.
Okay, really, really great analysis. Thank you, Anna, for joining us in the studio on the topic of UK inflation and the prospects for the UK economy. Anna, Andrade and Venram from our MLive team with a view that maybe rates here in the UK get to 5%. Thank you both. Right, coming up, we're going to continue our conversation on the health of the UK economy. We're going to bring in Josie Anderson, Managing Economist at the Centre for Economics and Business Research. Joining us next. This is Bloomberg.
I'm sorry, they got it wrong. Hopelessly so. The evidence is overwhelming. And it's puzzling in a way that the central bankers continue to resist this. I find I've been commenting on the Bank of England the best part of 50 years now. I have to tell you, the current lot is some of the worst I've ever commented on.
OK, we're hearing there from Tim Condon, former advisor to Prime Minister Margaret Thatcher and, of course, a famed monetarist in terms of his economic theory and thinking, talking and speaking to Bloomberg Radio. He also went on to say the UK is heading for a recession. Well, let's get some analysis then and some reaction in terms of what is happening across UK GDP. It flatlined, of course, in February on a monthly basis, though there was an upward revision to January's reading. The IMF has also warned that the UK is set to be the worst performing country among the G7 nations. Of course, the Chancellor of the Exchequer has pushed back on that view from the IMF and pushed back here with Bloomberg TV. Let's bring in now Josie Anderson, Managing Economist at the Centre for Economics and Business Research, for the analysis and the context. Josie, thanks for coming to the studio. Really great to have you in. Let's start with the GDP picture then. And we heard there from Tim Condon saying we're heading for a recession. The Bank of England's getting this all wrong. Money supply suggests that we're not only going to be coming out of inflation, he thinks we're getting into deflationary environment. It's an outlier view, but what is your take in terms of the shaping up and the outlook for GDP out of the UK towards the end of the year?
Well, GDP is an interesting one, actually, because the February data surprised on the upside. You know, we saw a strong January, no contraction in February, kind of a flatlining economy. So it makes a contraction in Q1 far less likely. You'd have to have had a really weak March. Now, that's still possible, but I think the big picture, rather than declining GDP, is flatlining GDP. You know, we can compare to 3 years ago, pre-pandemic, February 2020, and we've seen a tiny bit of growth, you know, 0.3%. So obviously we had the big recovery from the COVID contraction, and now the big picture in the UK is flatlining. So whether or not we'll see an actual decline in GDP this year is a big question. You know, will there be a recession? Prior to the February data, we're forecasting a 0.2 contraction over the whole of the year. I think it's likely that in our next forecasting round at the end of the month, we will have a slight upward revision, actually, because I think the UK economy has been surprisingly resilient. Consumers, despite this huge cost of living crisis, continue to go out and spend. So actually, yes, very weak GDP. We should be seeing growth. In the 3 years to February 2020, we saw 4.5% growth as a whole. And, you know, now we're talking basically no growth. But it's, you know, whether or not there'll be a recession is hard to say. It's flatlining.
So I want to unpack your views on where that relative resilience is coming from in just the next couple of minutes or so. But in terms of that stagflation view, or at least stagnatory view when it comes to the UK economy, as you project out to 2024, if you can do that, given all the uncertainty in terms of economic data, is this the near-term, the medium-term future for the UK economy, that we're going to be a flatlining, stagnant economy?
We do forecast a return to growth because ultimately I think one of the main sources of this flat GDP growth is the cost of living crisis. And we are forecasting inflation to fall, and with that, consumers should be better off. But, you know, despite forecasting growth in the coming years, it's going to be weak, you know. It's not going to be a strong economy because consumers are going to take time to recover from this big cost of living crisis. And, of course, all the other shocks we've faced in recent years, obviously, we're still, to some extent, recovering from the pandemic and the associated supply chain issues globally, and also, of course, the war in Ukraine. So growth's going to be weak. And, you know, it's to do with the cost of living crisis. There should be a bounce back. And
inflation, of course, central to that cost of living crisis. 10.1% the CPI print. We're an outlier versus the US and Europe. What is your forecast now for inflation by the end of the year, with a government that has set itself a target of halving inflation by year end? Do they get to their target? What's your forecast?
Yeah, so actually consensus expectations were, you know, it would fall below 10% in the latest data, but actually we were expecting it to remain above 10%, but we are expecting it to fall over the year despite that. You know, there are lots of forces pushing inflation down. The main one is, of course, energy, and we should see that come through much more strongly than it has already in the April data and also in the second half of the year, you know, as the effects of the wholesale energy prices are passed on to households, which can take time in the UK because of our energy price cap and the way we work.
What about core? What about services, that component, and are the rate hikes that are expected to come through from the BOE, are they going to be enough to get that core down and away from its stickiness?
Yeah, so like I said, there is a big force driving inflation down, but actually, on the other hand, it's sticky, as you said. So we're not forecasting it to fall dramatically. We're not forecasting deflation. You know, I think it remained high in the data we got yesterday because it can be sticky, and it's sticky, you know, because companies get used to higher price rises. You know, they in a way can profit off it if they face relatively inelastic demand. And also, you know, workers can bargain for higher wages in some industries. And there we see higher wage growth, higher than expected in the latest data. And so that's where inflation can be sticky in the industries that can kind of get away with those increases. And so, yeah, we're forecasting an averaging of 4.5% inflation over the last quarter of the year. So, yes, a halving, but
and
still
that's dependent on how many hikes from the Bank of England, because we were speaking to our rate strategist, Ben Ram, earlier on the show. He said he has 5% in view now in terms of the terminal rate from the BOE. Do they have to go that far to get inflation to your target?
Yeah, we're forecasting one more rate hike. We were forecasting that before
25
the data.
basis points
25 basis points, yeah. So up to 4.5%, and then we're not currently forecasting any more rate hikes. I think, yeah, we were expecting, you know, higher inflation in the March data, but we are also expecting it to come down. So April will be key for the decision after the next one. You know, the Bank of England will really be looking for slowing inflation, but we are forecasting 4.5%.
And you think the door opens to cuts from the Bank of England before the year is out?
Yeah, right at the end of the year, you know, possibly December, and no dramatic cuts. But, if the Bank of England starts to see inflation falling and is dealing, with a very weak, flatlining economy, it might start to think, how can we spur on some demand, actually? Because right now it's kind of focused on getting that demand down, and it's hurting consumers, it's hurting households. But at the same time, that's the main method they have to deal with inflation, it is impacting demand and,
Just
making consumers...
Very briefly, on the housing market, how fragile is that?
Yeah, so I think this is where one of the key areas where the UK is weaker than other countries in that it has a stronger reaction to weakness in the housing market. And we are forecasting a fall this year of a 3.7% contraction in prices. That's an improvement on previous forecasts. The housing market, like the whole economy, seems to be more resilient than previously forecast, because obviously we have, we've had these huge increases in interest rates from the Bank of England, and that's impacting mortgage holders a lot. And so mortgages have become a lot more expensive. But yet the housing market seems to have been quite resilient. But a contraction will impact, it has big wealth effects in this country. A lot of households will feel poorer if their house price falls. And of course, you get significant impacts on certain people. If they can't afford their mortgage anymore, they might have to sell their house.
Okay. Josie Anderson, smart insights. Thank you very much for coming into the studio. Josie Anderson, Managing Economist at the Centre of Economics and Business Research. Coming up, what European city are Wall Street bankers now banking on after Brexit? We'll give you the answer and why after the break. This is Bloomberg. Economics, finance, politics. This is Bloomberg UK. I'm Tom Mackenzie in London. Now, for decades, London was the main nexus of European finance. But 2 years after Brexit became a reality, there's been a clear shift across the channel. That is the subject of today's Big Take. Joining us for the details is Bloomberg's Alex Rajbandari. Alex, is there really life after London then?
Yes, there is life after London, Tom, and it seems to be in Paris. There was a lot of debate after the Brexit vote about which city in Europe is going to win the big chunk of the financial industry that the city was representing for decades. And it seems like Paris has been getting a fair share of it. In terms of trading, it's become the main European hub for trading on the continent now. And banks have been pouring in talent and relocating people and hiring people here. When you look at JP Morgan, they have a 22-fold increase in terms of traders in the city. Citi is building a new trading floor. Goldman Sachs has a new building across, just a throw stone away from the Arc de Triomphe. So banks have been betting big on Paris, and now we can see there's a new ecosystem building around finance in Paris. And that's not just banks. Hedge funds have been following the trend. If you look at Millennium,
Does it have momentum, that kind of investment? Does it keep going? Or do things like the protests that we've seen across France put a bit of a headwind on that?
Well, I mean, protests are quite temporary. And when you look at the decisions that banks have been making in terms of relocations and investment and loan books that were moved and transferred to Paris, eventually these are big decisions that won't be scaled back or scrapped just because of a temporary thing like a protest. And there have been protests in Paris, but the banks are making efforts to make sure that the people they relocate to Paris are settling in for the long term. They provide French lessons, they help them find schools for their kids. They're not just providing a 2-year stint in Paris. They are really looking to make the financial ecosystem here in Paris grow and see people get a career here.
Alex Rajbandari, on that shift then from London to Paris, it has momentum. Stay with us. Bloomberg Surveillance Early Edition continues in the next hour. This is Bloomberg.
Everybody's anticipating that we're still going to have this tightening of lending conditions, tightening of credit conditions that takes place, that reduces growth.
The real economy is much more aligned with these regional banks and small businesses, and they're expressing concern about getting access to credit.
We are expecting slowing of credit availability, but we're not seeing it creating this big cratering crunch in credit conditions.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Tesla's not done cutting prices on its electric vehicles. Elon Musk says the company can withstand lower margins, but investors are skeptical and shares are falling. Another sign that the slump in computer chips isn't going away. Taiwan semiconductor TSMC forecasts worse than anticipated revenue for the current quarter. And New York Fed President John Williams warns that banking turmoil may make it tougher for households and businesses to get credit. Still, he says the system is sound and resilient. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. And I don't know if it's the beige book wasn't beige enough, Matt, or it's the Tesla sort of sentiment hangover, but something's knocking futures this morning.
Yeah, and TSMC also not great news. I mean, the shares aren't doing poorly in Taiwan, or didn't do poorly in Taiwan, but you've got a slate of what looks like, down arrow stories. Credit crunch, not sure how crunchy quite yet. Tesla needs to cut prices again. That's bringing the entire sector down. And then you've got the possibility that the chip slump and maybe the chimp slump isn't quite behind us yet. In any case, stocks, after doing a whole lot of nothing yesterday, trading in a very tight range and closing basically unchanged. We see futures down now 0.8%. So that's a pretty decent drop in S&P futures this morning. Investors are buying government bonds. That pushes the yield down just a little. Remember, yesterday we were at 360, I believe. Right now we're at 356 on the 10-year. And then we see a whole lot of assets coming down. NYMEX crude off $1.36, now under 78 to 77.80. Bitcoin off another $400, now under 29,000 at 28,839. I think gold is just holding steady right now at about 2,000, but you've got a real risk-off mood. Take a look at what's going on in Asia, or what happened in Asia overnight. You saw the MSCI Asia Pacific Index closing down about 0.2%. And I wanted to highlight Taiwan Semiconductor first. We're going to talk about it in a little bit, right? Because the shares are actually up about 0.6%, but they've come down since the middle of March from about 540 to 513 where they are now, and they cut their forecast for the full year. So there's maybe a problem in chips, but maybe we're bottoming out. I believe that's why you may have seen a bounce in Taiwan. The Nikkei gaining, but only 0.2%, and the dollar losing a little bit of ground against the yen. You can buy 134.67 right now. Anna, what do you see in Europe?
Yeah, we see negativity in Europe then, Matt. Certainly the auto story, we'll get to Elon Musk and what he's doing at Tesla shortly, but that's having an impact on some parts of the European equity space. There's that, and then there's the different readings you can give to the beige book. For some people, this put the emphasis on reduced credit, stalling US economy. For others, it wasn't as bad as maybe they'd anticipated, but either way you look at it, European stocks looking on the downside today and moving lower. The French market, the German market in particular, vulnerable to what we're seeing in autos and auto suppliers as well. So let's focus in on that sector and show you the weakness we've got coming through on autos. There's some specifics around individual ones. So the stock 600 autos index down by 3.4%. So it is broad-based. It's got some auto suppliers in there as well as the manufacturers of the cars themselves. One of those manufacturers really coming under pressure, down by 7.4% for Renault. And this is a business that, yes, is affected by the sentiment from Musk and the price-cutting narrative, the pressure on margins there, but also the fact that they put out earnings and the first quarter numbers actually look better than the market had anticipated, but the Musk story dominates. I put in Stora Enso. This is a packaging business in Finland that we don't talk about all that often, but it's down by 2%. And what drew my attention to this was the fact that they said that all areas of the packaging market are currently weakening, which seemed like an interesting take on one part of the global economy. And L'Oreal's a really interesting story as well. The French cosmetics and beauty products manufacturer coming through with numbers that pleased investors, it seemed, even though they weren't able to do as much business in the first quarter in China, not because there wasn't the demand, but because they didn't have the merchandise in place. A nice reminder of just how surprised we were at that Chinese reopening story at the time and the way that it might have left some businesses a little off-centre when it came to the start of this year.
All right, so we'll continue to watch that and talk about what's going on in luxury and the makeup space, which has been highlighted over the past couple of days. Let's get to the car story, though, right now. Some calling it a tech company, but basically their business is making and selling cars. Elon Musk signaled Tesla will continue to cut prices to stoke demand for its electric vehicles, even at the expense of his fat profit margins.
While we reduced prices considerably in early Q1, it's worth noting that our operating margin remains among the best in the industry. We've taken a view that pushing for higher volumes and a larger fleet is the right choice here versus a lower volume and higher margin.
For more, we are joined now by Craig Trudell, our global autos editor. Craig, we've been talking about these margins, and they were pretty amazing. I think 20% last year, but they've come down by about half. How much more can Elon Musk cut prices?
Yeah, I think that's the question, right? You heard the case from Tesla going into these earnings that there wasn't going to be a choice, right? That you could have both, that you could have growth and these really huge, these really substantial margins. And I think what we heard from the company last night was something very different. This idea that they're very much willing to see these margins shrink beyond what they have already. And we kind of knew that going in, right? We had 2 rounds of price cuts already this month, so we knew that that's going to really pressure the second quarter numbers. And I don't think we got any sort of assurances that they're done. If anything, there was sort of further signaling that that there's more to come here, and that they're motivated really to bring their lineup down to the level that more people can afford them.
What's going on with European car stocks then in response, Craig? Is this in response? I mean, we see Renault down by 7.7%, Volvo cars down by 5.4%, Stellantis, Faurecia, both down by more than 5%. So this is autos, it's the suppliers to autos, a real area of weakness today. Is this something that Elon Musk said on the call, or is this something else?
I think if you look at Renault, they have started to roll out some electric vehicles, but they have a lot more coming, right? And some of these are in the segments that you would sort of expect Renault to play in, some of the more mass market segments. And when you see the Model 3 going much lower and sort of indications or hints that they're not done cutting, that really is a sort of cause for concern if you're Renault, in the sense that even while it's kind of ironic, the first quarter numbers were actually pretty solid for them, but it's really more so about the outlook, and they got a lot of questions, really kind of a drubbing as to what's the outlook for your EVs going forward. I don't think they necessarily gave the answers that the analysts or market was looking for.
Okay, so it's about the outlook and that competitive environment then in the wake of Tesla. Craig, thank you very much. Bloomberg's Craig Trudell with the latest on the auto space. Let's go to chips. TSMC has forecast worse than expected revenue for the current quarter, reflecting a persistent slump in demand at the chip-making giant. Bloomberg's Alex Webb joins us now with the details. But Alex, they're sticking to their capex plans. So what is the overall story here at TSMC?
Well, they are very much the key bellwether in the tech industry when it comes to understanding what electronic consumption looks like right now, and also what their customers are ordering. You find their chips in smartphones, in computers, in cars, all over the place. At the moment, it's not looking very good. They did beat expectations for the March quarter, but they had already cut their forecast of that, so expectations were pretty low. Looking into this quarter, they are below expectations in terms of forecasting what they say this quarter is going to be like. They are more optimistic for the second half of the year. Second half of the year, of course, is when we start to see new iPhone models. That is, one of the biggest products that they supply chips for. Perhaps then they're also looking for greater demand as a consequence of some, economic measures as well.
In terms of, sorry, Alex, the one thing I'm thinking when I look at the shares, right, they're up a little bit, and I know that they've come down from a higher level, but is it possible that this at least signals to investors a bottom is getting put in?
It's very hard to tell with a company like TSMC. They've not been trading from a multiples perspective significantly above the rest of the market. They're facing increased competition as well. And obviously that takes longer to come in, but Intel is really coming for them at the moment. Whether they can do that, huge question. The glimmer of hope that investors are looking towards and that TSMC is trying to feed them is the prospect of AI, that actually you need advanced chips for AI to work at the bleeding edge. We are now seeing some of that, as we've seen with ChatGPT and plenty of other examples, come into the public domain, that is the glimmer of hope on the horizon for a new leg of growth.
And definitely something that PR spinners around the world are feeding to journalists for sure. Alex, thanks so much for joining us. Bloomberg's Alex Webb talking to us about TSMC, a bellwether that we're all watching very closely for chips around the world. Now let's get to the Fed's beige book. Not quite as boring as the name would indicate. It says that the U.S. economy stalled in recent weeks with hiring and inflation slowing and access to credit narrowing as well. New York Fed President John Williams echoed that sentiment. Listen in. Actually, you know what? I'll just read it. The banking system is sound and resilient. Nonetheless, these developments will likely lead to some tightening in credit conditions for households and businesses, which in turn will weigh on spending. Sorry, that was not a sound on tape. That was just a rip. Joining us now is Ven Ram, Bloomberg Markets cross-asset strategist. So, Ven, this just adds to a lot more signs out there that we're looking at the possibility of a credit crunch.
Morning, Matt. Yes, it definitely does. Maybe we shouldn't call it the beige book. We should call it the book that is still going fast from green to red, green to amber to red, shall we say. Look, there is no question that the U.S. economy is losing momentum and losing momentum rapidly at that. And we will get a readout of the April PMI numbers tomorrow, so we will get confirmation of that. My own suspicion is that this long tail of the economic expansion will lag simply because of the strength in the labor market. So I don't think we are going to get into contractionary territory before the autumn. So until then, we'll muddle through these numbers. And after that, we are going to get a slowdown. The question is, how severe is the slowdown going to be and how protracted it is going to be? And we don't know those contours yet, just yet.
Yeah, we don't have the answers to those things. We look for clues always. Ven, good morning. So Matt sent me a story on corporate bonds, which I thought was interesting, putting fallen angels front and centre. It seems that corporate bonds are being cut to junk, which is what a fallen angel is in the corporate bond space, at the fastest pace since 2020. And of course, 2020 stands out for obvious reasons. You have to go back to 2016 and 2009 to find periods where the rate of creation of fallen angels was this high. Does this worry you, Ven?
Morning, Anna. I don't think it's a big concern as of this point because it's an expected outcome of the Fed's tightening cycle. The Fed has tightened rates phenomenally in this cycle, much more than it has done so in decades. So what we are seeing is a reflection of the tightening. And, you know, it is natural for credit rating companies to lower the ratings of these companies because you know, their debt serviceability at higher and higher levels of interest rates is being called into question. But if the U.S. economy loses momentum, as we just discussed, and if we go into a soft patch in the economy later on in the year, I think these corporates will get some respite. So there is no evidence of any systemic crisis as of now, and we are all hoping that that will remain the case as the year progresses.
One thing we can say for sure is that borrowing is getting more expensive then, and especially for banks buying these high-grade credits, they're going to be demanding more of a risk premium to own this stuff. Ven Ram from Bloomberg's MLive blog, thanks so much for joining us. Take a look at some of the stocks that we're watching in the pre-market today. There's a lot going on under the hood. First off, the casinos, led by Las Vegas Sands, but also watch MGM and Wynn. They have been moving in the pre-market. LVS reported after EBITDA, property EBITDA, adjusted property EBITDA. They have a lot of caveats there. Rose and beat the average estimate of analysts. So $792 million was what they had. That, you know, quintupled from what they had the same time last year, but the street was looking for $605 million. So still doing a lot better than the estimate. As I said, watch the others to move in sympathy. We did see Wynn Resorts move in the post-market yesterday. It's not doing anything in the pre-market this morning, but MGM is up about 0.4%. IBM also gave a forecast for annual revenue that was in line with analysts' estimates, delivering a cautiously optimistic signal about technology spending at a time when some of its peers have been cutting guidance. And this is just one more sign, I think, if you add to TMC, that maybe the bottom is in this quarter. TSMC said that they feel like that's what the case is, and maybe that's what investors are taking away from IBM as well. Those shares up 2% in the pre-market. And then Anna mentioned European car makers. Look at U.S. car makers, one of which we share, right? Stellantis is listed here. It's also listed in Italy. It's also got probably a Dutch headquarters. They're global, right? But Tesla and its announcement that it's going to continue to cut prices to take market share, that's hit that stock, which is big and going to drag on the indexes. But you also see Stellantis off 5%, GM off 2%, Ford off 2%. So this is a concern for the entire industry, Anna.
Yeah, absolutely. We're certainly seeing the pressure on, as you say, the auto sector here in Europe. Coming up, Christian Sinding joins us, the CEO of the Swedish private equity firm EQT. We will talk about what valuations look like from his perspective right now. We'll also get an FX perspective. Esther Reichelt joins us, Commerzbank FX strategist. She'll be on deck to give us her thoughts on where the dollar goes from here, the pound, the euro, and much beyond. Plus, it is day 2 of the Bloomberg New Economy Gateway event outside Dublin. Today, we'll be hearing from Ireland's Prime Minister, Leo Varadkar, BlackRock Vice Chairman Philip Hildebrand, and Ireland's Finance Minister Michael McGrath. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Now, in a tough environment for private capital, one of Europe's largest private equity funds, EQT, has had a stellar first quarter with deal activity picking up. Joining us in London is Bloomberg's Danny Berger with the CEO of Swedish private equity firm EQT. Danny?
Matt, thanks so much. That's right. I'm here with Christian Sinding. Christian, thanks so much for joining the program this morning. I know you just finished your analyst call about an hour ago. And look, the numbers here, deal activity picks up to $5 billion. You're still bringing in a higher AUM of those fee-generating assets, but your shares fell as much as 2% this morning. Now, I know you're going to tell me you don't care about the share price, but why do you think there's been a slight reaction, perhaps, of disappointment?
Yeah, I think, can you hear me okay? I'm getting a little bit of a fuzzy feed, but if you hear me fine, that's great. Yeah. No, you know me, Danny. I won't comment on the stock price, but if you take a step back, I think investors are still uncertain about what's happening in the global economy and the global capital markets. And therefore, we who are working with transactions, investments, and exits are are part of those cycles. I think what's important to us is that we're now putting capital to work again in interesting companies and interesting buildings, and we see opportunities to create long-term value for our clients, and that's ultimately what's going to drive the valuation of EQT.
Right, in your earnings statement, you talked about the fact that you are seeing deal activity pick up at the start of the year. How far away are we at this moment, Christian, to having a more normal deal environment?
I wish I knew. What we're seeing in the market is still, it's still complicated. The financing market is open, but still not open for larger transactions, and probably about $2 billion of financing in Europe and about $4 billion of financing in the US. A bit larger than that in infrastructure, which is inflation protected and has more robust downside. If you look at the exit side of the equation, the IPO market is open for medium-sized and smaller companies, but it's not open for the larger transactions. So the larger deals, like some of the bigger companies that we own in our private equity infrastructure business yet. So I think right now it feels like we're in a period of some people are saying no landing, and that probably is going to be it's going to be like that for a while in our expectations. So what we're trying to do is to find the right companies in the right sectors, put capital to work with those, and build long-term value.
And in this environment, it's one of uncertainty. Do you think public equities are too richly priced right now, given all of that?
I think it's hard to say. If I look back, I think it's the corrections that you've seen in growth, very high growth businesses where valuations were extremely difficult to understand. Some of the biotech market, the fact that the SPAC balloon has been punctured. I think that's actually quite positive. It brings some more resilience and grounding to the capital markets, and that's the time when we can start to do transactions. So We're now in an active dialogue on a number of public to privates, and those dialogues are intensifying. So it looks like sellers and buyers are starting to come together between the private and public market. And maybe that's also a sign that the public markets are, reasonably valued. But if I knew that, I probably wouldn't be in the private markets.
Well, part of the reason I do ask is because of the take privates, Christian. As you say, of course, DEKRA, the pet med veterinarian company, that one, I should say it is a pretty expensive valuation, about 72 times EBITDA. When you're looking at some of these take privates and you say, hey, I like this company, but it's a challenging environment, we're holding on to things for longer. How do you approach these kinds of companies when you are having to pay up in order to acquire them?
It's a really good question. What we do is we build. Well, first of all, we take a step back and say, do we want to be in the sector? And we're big investors in the pet sector. We're big investors in healthcare, and this kind of brings both together. So the secular trends behind that industry are very positive. And then you have the company itself. We think has a lot of potential for future growth. I can't really comment anymore on that. It's still just early stages. But the mindset more generally is that we believe that it's our job to find the right sectors, the right subsectors, and the right companies in those, and take a really long-term mindset. And then hopefully some of those transactions will go through during this next cycle.
Right. Well, I mean, you see it around London. Basically, everybody has a dog at this point. So I understand those sorts of secular trends. Christian, before we let you go, last year you made an acquisition for Barings Private Equity Asia. You've talked about before this idea of the difficult fundraising environment. Do you think at this point in time, you and your peers, in order to attract investors, you just got to be bigger?
Yes, there's a clear trend in the private market space of, like in other professional services and banking and consulting, et cetera, of a consolidation. There's something like 7,500 private markets firms in the world. But over time, there's going to be 10 or 12 or 15 or whatever it might be, large global players, of which we're one. I think we're maybe top 5 in the world now or something like that. And those companies are able to put a lot more resources into the thematic investment strategies, into value creation strategies. We've had an AI program for a long time now. We're accelerating that with generative AI and global capabilities, so you get global insights into sectors, and putting that all together in multiple different asset classes around the world and being able to receive larger amounts of capital. So if you look at this last fundraising cycle, 57% of all capital raised in private markets went to the mega funds like we have. So that trend is accelerating. And of course, that's also going to drive some future M&A in the market as well.
Yeah, got a feel for the small guys in this environment. Hey, Christian, really great to catch up with you today. That's Christian Sinding, CEO of EQT. And with that, Matt, I'll toss it back to you.
All right, Danny, thanks very much. Bloomberg's Danny Berger talking with the CEO of EQT. Now keeping you up to date with news from around the world, here's the first word. Democrats are rejecting House Speaker Kevin McCarthy's proposal to raise the debt limit for about a year and cut government spending. The plan would increase the debt ceiling by $1.5 trillion. It would also cut discretionary spending by $130 billion. If the debt limit isn't raised, the U.S. could default on payment obligations as soon as June. The U.S. Supreme Court has extended access to a widely used abortion pill until at least Friday. Justices are considering whether to allow restrictions, on the drug to take effect. A lower court in Texas has ruled in favor of abortion opponents who want to roll back FDA approval of the pill. And inflation is making life harder for British consumers. The price of a full English breakfast has jumped to a new high, according to the Bloomberg Breakfast Index. The average cost of ingredients is up almost 23% from a year earlier in March. The price of milk rose 40%, while bread increased 33%. I would pay you, Anna, to take the mushrooms.
Yeah, absolutely. I wonder if there's been a reduction in heart disease as a result. Esther Reichelt joins us. A look at FX markets next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Tesla's not done cutting prices of its electric vehicles. Elon Musk says the company can withstand lower margins, but investors are skeptical and shares are falling. Another sign that the slump in computer chips isn't going away. Taiwan Semiconductor, TSMC, forecasts worse than anticipated revenue for the current quarter. And New York Fed President John Williams warns that banking turmoil may make it tougher for households and businesses to get credit. Still, he says the system is sound and resilient. I'm Anna Edwards in London with Matt Miller in New York. And Matt, it seems negative sentiment coming from somewhere, from the earnings story, maybe around Tesla. That's certainly weighing on sentiment here for the auto sector. Also the beige book, all of that adding up to a negative futures picture.
Yeah, absolutely. I think there are concerns about credit availability, credit tightening, and of course the car makers are down on both sides of the Atlantic. They're getting hit pretty hard here as well. Tesla itself, not a small company, so when it's off 7% or so, that's bound to drag on the broader indexes. Check out futures right now off about 3/4, a little less than 0.75% on the S&P. It should be said that the S&P did a whole lot of nothing yesterday and the day before, so it's hovering still at over 4,100 in the cash trade. Maybe some of those gains are going to be given back this morning. We have had yields rising pretty steadily over the last week. Now it looks like that's turning around as investors buy U.S. Treasuries. So 10-year yields down again below 360 to 357.56. And NYMEX crude falling once again. You know, it rose up to $83 and change last week. Yesterday it was back down below 80. Today it's down below 78. So there's a real question of demand here, because even as OPEC Plus continues to cut production, at least announced production cuts, the price of crude just can't stay, NYMEX at least, above 80. Of course, Brent is up there, but probably coming down to that big round number itself. And then Bitcoin, a second day of drops. It fell below 30,000 yesterday after coming back up on Tuesday. Now it's below 29,000 at 28,876. So still a pretty hefty price compared to the 16 grand that we saw after the collapse of FTX. But it is slowly moving lower. In terms of pre-market movers that are moving higher, we do have Las Vegas Sands up 4.5% in the pre-market after reporting adjusted property EBITDA, so operating profit at its properties adjusted for last year for comparability. It beat the average analyst estimate by a heck of a lot. It came in at $792 million, and the street was looking for only $605 million. Watch Las Vegas Sands and its peers. IBM gave a forecast for annual revenue that was in line with analyst estimates. Not terribly exciting. It was cautiously optimistic about technology spending, but a lot of its peers have been slashing guidance. So maybe IBM is doing better than the rest. As a result, in the pre-market, it's up 1.5%. And then Tesla, as we've been talking about, signaling more price cuts ahead. Its margin halved from 20% last year to 10% in this quarter, and now the shares are down another 7.5%. Anna?
Yeah, really fascinating, the Tesla story, and that's certainly echoing across the Atlantic then, Matt, putting pressure on the auto sector. This is the picture for broad European stocks as a whole, down by 0.3%. The auto sector really stands out. We talked about Renault, down by more than 7% earlier on. Some of the suppliers, too, it's not just Renault, though, Stellantis as well, and some of the suppliers to the auto industry really under pressure. So as a whole, that sector down by more than 3%. The French and the German markets a little weaker as a result. This is an interesting one on the global economy. Stora Enso makes paper and packaging, and their numbers, they guided lower in terms of what they'll achieve on EBIT this year because of costs, and it's the things you would expect around energy and chemicals and the like, but also around demand. And they said that all areas of the packaging space, of the packaging space that they supply, all areas were coming under pressure and were weakening at this time, which seemed interesting. L'Oreal up by 0.7%. So in a lot of geographies, they pleased with the sales numbers they put out after the bell yesterday. But on China, they disappointed, but maybe for the right reasons. They could have sold more in China. They just didn't have all of the merchandise available because of the speed of the reopening story that we covered, of course, at the end of last year, Matt.
All right, definitely one that we're going to continue to watch, one we've been talking about for a couple of days now. Both, I think, luxury and specifically makeup, have been in the spotlight. I want to go, though, from there to FX, and I can't think of any decent transition. Joining us now is Esther Reichelt, Commerzbank FX strategist, to talk about, the effects of central bank policy, central bank credibility, and credit tightening on currency pairs. Esther, first off, what do you make of the hiking cycle around the world? It seems to be reaching its peak. Certainly, we expect the Fed to raise one more time and then hold. That's kind of consensus. Is that your view as well?
Well, yeah, our U.S. economists still see the potential for further rate hikes. I think everybody will be focused on the data that are coming out over the next weeks, in particular the GDP data for the United States, of course. But of course, we are clearly hearing more cautious voices from the Fed, and I think so. This sentiment, this cautious U.S. dollar sentiment, will prevail into the Fed meeting in May.
And the ECB is a different story, though, right? Because they could raise 50 or 25 at this next meeting. Who knows what they'll do at the meeting after that? Is inflation stickier in Europe?
Well, absolutely. I mean, we have seen inflation numbers being much higher, coming down slowly here in Europe. Like the alarm bells got off again yesterday after the high UK numbers. And we are also hearing a much different rhetoric from the ECB. Like nobody is talking about an end of rate hikes. It's rather being discussed, will it be 50 or 25 basis points right now? And of course, this is supporting the euro. However, we still have to remember that the doves are immensely powerful within the ECB. And I think as soon as we are seeing signs of a slowing economy, signs of inflation data, of disinflation, of core inflation leveling off, I think the doves will take over. And I do not believe that, like the ECB rate hiking cycle will continue for much longer than into summer.
Okay. Esther, good morning to you. So the doves might take over. Interest rate differentials might start to play in a little more as well. I mean, clearly we've seen the euro gaining because of expectations around those differentials, and the gap maybe between the Fed and the ECB closing. If the ECB continues hiking after the Fed has paused, how much do you think that the ECB can go on hiking, even if we see sufficient weakness in the US economy that we see a pause from the Fed? I ask this because Klaus Knot at the ECB is saying they might need to hike again in June and in July.
Well, Klaus Knot is certainly the most hawkish member, and his view will not reflect the consensus within the ECB. However, I think the euro has already gained substantially, and I think any more upside in euro dollar will most likely rather come from the Fed side. That means, like, if the Fed is indeed moving towards rate cuts, I think this is more likely to push euro dollar higher than much more upside on the ECB side, because, as I said, this is most likely to be limited due to the strong power of the doves within the monetary policy board.
Yeah. How do you think that the pound will continue to price in the Bank of England expectations and the latest data around the UK economy? Esther, I asked this because yesterday we saw a great deal of volatility in the pound. We got that inflation data, which in some circumstances might have just caused the market to buy the pound on the expectation of higher interest rates. But then some people took a pause and thought about maybe the weaknesses, the weak areas of the UK economy. How would you expect the pound to trade from here?
Yeah, the pound is really a very specific factor because there are also very strong idiosyncratic factors to this strong inflation numbers, and due to the Brexit, of course. And what we've seen, however, over this whole rate hiking cycle was that the Bank of England always remained rather cautious, rather reluctant. They were always delivering what was needed to keep the inflation outlook in check, but not much more. So they weren't very active in bringing inflation down, but rather waiting for time playing out for them. And we actually believe this most likely to continue. So yes, yesterday much more rate hikes were priced in, but the Bank of England really has to deliver for the pound to sustain the gains we have seen. We rather see potential for some more weakness, given that the Bank of England had been so cautious and was actually waiting for an opportunity to pause rate hikes. So I think this overall more cautious sentiment will actually be more dominant driver in pound sterling exchange rates going forward.
You know, I want to ask about the dollar broadly, because we've seen the Bloomberg Dollar Index come down significantly from its peak last year. We were up at 1353, I think was the high, and now we're trading down at 1226, 1227. Is consensus for a continued drop in the greenback? I mean, is it going to continue to fall against major currencies it trades against around the world?
Actually, I don't believe so. I mean, simply because there is already so much priced in. You know, like the market is already expecting these rate cuts. Yes, we'll most likely see some more US dollar weakness as soon as the Fed is also moving towards these rate cuts and start discussing them. So then we are going to see some more US dollar weakness. But in general, the view that is currently priced into the FX market, in particular into dollar exchange rates, seems to be rather viable or rather feasible, given the economic and inflation environment we are seeing in the United States, and of course the uncertainty that's still dominating, in particular with the view on how credit, or whether we are going to see a credit crunch or not.
I can ask you about something that we don't talk about very often. That's the Hungarian forint, Esther, and it's doing a whole lot of nothing today. But yesterday we saw substantial weakness on some comments that looked like we could see more political pressure on central bankers to cut rates. Is that something that interests you, Esther, either in the way that the HUF trades or in the broader theme that it represents?
Yeah, absolutely. Because actually yesterday's movements have confirmed us in our very cautious view with regarding the forint, given this lack of credibility of the central bank, or rather this, like unclear view on the central banks, because the Hungarian central bank has always been criticized of not, not sticking to a tight monetary policy long enough. And we are also seeing political pressure from the government side to cut the rates, because they have hiked rates considerably. However, then they have moved to a less transparent interest rate system. And yesterday, was actually an indication, because, the central bank once again signaling maybe the potential for rate cuts. This actually confirms our view that the market is right in being, very skeptic about central bank credibility in Hungary. And we believe as soon as this whole uncertainty about the banking sector, this uncertainty about the inflation picture, as soon as this levels out later this year, the Hungarian central bank will move to an easier monetary policy, and thus weighing on the forint.
Okay, Esther, thanks so much for your time. Esther Reichelt of Commerce Bank joining us to talk about all things FX. Coming up, more US regional banks out with earnings today. We'll preview what to expect. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with Bank OZK CEO George Gleason. That is at 4:30 p.m. New York time. This is Bloomberg.
We are not in a banking crisis, but we have had and may still have a crisis among some banks. I believe strong regulatory intervention on both sides of the Atlantic led to the cauterization of the damage. I consider the current issues as not remotely comparable to 2008.
That was James Gorman there, CEO and chairman of Morgan Stanley, speaking after the company reported profits falling from a year ago amid a slowdown in investment banking that, we've all really been watching. Meanwhile, regional bank earnings continue rolling out today with East West Bancorp, Comerica, and KeyCorp all on deck. Investors are going to be looking for signs of contagion or healing from the recent turmoil in the financial sector. Shonali Basak, our global finance correspondent, joins us now. So where do we focus? The big banks or the regionals? I mean, they're both exciting stories.
It's time to move to the regionals, and it's because we're still watching the deposit story, but we're also watching other things like pressure on net interest income, profitability, exposure to commercial real estate, and other kind of risky areas. We saw from Ally, for example, that there are more worries about auto that are still building in the market. Questions about the housing market as well, because remember, when you look at the biggest banks, the loans tied to mortgages are really, really falling off a cliff. They have been falling significantly. But data yesterday shows that some housing prices are really starting to cool. So when does that start to turn around, even with higher rates that we're looking at? So really, it's profitability alongside of stability of the banking system that we're looking at, Matt.
So, what's interesting to me is whether or not we're going to see competition for higher deposit rates, right? My local bank is still giving me 0.02%, but a lot are offering 4 or 5% in higher yielding accounts.
Apple, Goldman.
Exactly. Is that going to hurt, these banks' bottom lines? You talk about net interest margins.
Yeah, it's also the cost of funding. And it's not even just the small regional banks. That was the worry about things like Schwab as well. So, yes, the short answer is there's a real worry about the cost of funding as we move over, especially when you look at the larger banks and not only how stable they've been. Morgan Stanley brought in $110 billion worth of net new money yesterday, or in the first quarter. You also had JP Morgan saying net income is rising, net interest income is rising by the billions of dollars. I don't see that kind of message coming from everywhere else. Again, this is not just about the deposits, the idea to lend into this economy and the provisions ticking higher, Matt. Remember, charge-offs are starting to also rise as well. So that profitability pressure is the next thing that people will turn to. Some of these stocks had significant recoveries, and not just the stocks, the bonds as well. Just think about Western Alliance, which was trading 50 cents on the dollar, give or take, and has risen by more than 20 cents, almost 30 cents. So people who bought those bonds at the low are really, looking at some substantial gains there.
Yes.
Listen, though, what's interesting about that, though, I talked to some investors yesterday about whether they would be trading the debt and the equity, and they said, listen, until we get through this season, we're still kind of concerned, which just shows you that there are still jitters in the market here when you look at kind of the end game for where these banks are headed.
Right, and thinking about what we've learned this week, Sonali, and there's been a lot in terms of the big bank story. Morgan Stanley was the last of the big names to report, and a real focus on something else that maybe wasn't in focus at others. That's the wealth management story and success there.
I think it's fascinating because, and like we said, they wanted a lot of net new money. They also kind of said that net interest income was not going to expand more meaningfully in the coming quarters ahead. But with that said, I think James Gorman called it a monster. It's such a large giant in Morgan Stanley's business lines now. But remember, what's interesting is you see Goldman also trying to focus on asset and wealth. JP Morgan also a large asset and wealth business with some of the best returns in the entire company. People forget to look at the ROE within those businesses. They're quite large. So all the banks report that business very differently. But remember, I think the point you're making here, Anna, is in that business, there is also lending and there's also deposit taking. So banking to high net worth individuals has certainly been a larger and larger trend, and a flock to the larger regionals where you see more of the success in lending and in terms of deposit taking as well.
And I think we carry on with some big names in the financial services sector with Blackstone numbers due out.
Yeah, it's time to look at the whole picture, right? We have to start looking at the credit card companies. We have to start looking at the private capital firms. Remember, private capital has been playing a huge role in these banking tremors, right? James Gorman is saying it's no crisis anymore. And so if you look at what private capital is doing, these private credit markets are not just filling in holes in corporate credit. Now you have a lot of these types of firms, Bloomberg has reported over and over, that are trying to find ways to pair with these regional banks, provide capital solutions to these regional banks. We'll also want to hear from Blackstone about the commercial real estate sector at large. In prior quarters, they've already taken some write-downs on the small portfolio of offices they already have. We've seen them default on some smaller portfolios as well around the world. But listen, really, John Gray's word about the real estate market and how much more pain there could be ahead is a big signal ahead.
When do you talk to John Gray?
8:30 today.
8:30 today. All right, we're going to tune in for that for sure. I just want to quickly talk about, you mentioned the cost of funding and corporate credit, and there was a great story on the Bloomberg overnight that banks are going to need a higher risk premium. They're going to demand more lend money to corporations, and that's going to just push spreads wider and wider
And
for
it's
companies.
not just corporations. I think both corporations and institutions. If this was a market that ran on leverage for however many years, then what happens as that cost goes up? A lot of the hedge funds and institutional investors have a lot of very levered trades in the market. So yes, the cost is certainly, if the cost is going up for the banks, you could expect a multiplier effect for the clients as well.
All right, Sonali, thanks very much. We'll watch for that interview with John Gray later on today. Of course, Blackstone's John Gray is going to be joining us, President and CEO, joining Sonali, I should say, at 8:30 a.m. in the midst of Bloomberg Surveillance. That's an interview you don't want to miss. If you're in London, that's 1:30 p.m. Set your watch. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. And Matt, let's have a quick look at what is coming up today. At 7:30 a.m. Eastern, the ECB will publish the accounts of its monetary policy meeting held last month. We already got the sort of hawkish news flow when we talked to Esther from Commerce Bank a little earlier on. An hour later than that, at 8:30, we'll get an update on the US labour market with the latest initial jobless claims numbers. At 10 a.m., US existing home sales data will be released. 15 minutes later, US Treasury Secretary Janet Yellen will deliver remarks on the US-China economic relationship in Washington, which could be of interest. And throughout the day, we'll be hearing from a host of Fed officials, including Christopher Waller, Loretta Mester, Raphael Bostic. I think there are others in the mix as well. Plenty of Fed speakers. And that's interesting because then we go into a quiet period, Matt. And so if the Fed has anything to say, they have plenty of opportunity to say it. If we're hearing from Bostic, Logan, Bowman, Mester, and Waller today.
Yeah, a lot of Fed speak, and likely they're going to be telling us the same story that the market already anticipates. One more hike of 25 basis points on May 1st, and then a pause. But of course, we still have a slew of economic data coming in between now and the meeting. I mean, for example, we have the non-farm payrolls number, which used to be referred to as the granddaddy of all economic statistics, coming out right before...
That's when there was no inflation.
Exactly. Right before the meeting. That's exactly before we paid such close attention to the PCE and the CPI and the PPI and everything. But we'll be watching it all, and so will the Fed. So, you know, I think John Maynard Keynes has been horribly overquoted in saying something like, when the facts change, I change my mind. What do you do, sir? Blah, blah, blah. But the Fed obviously is very data dependent.
Absolutely, very data dependent, and we'll also get PMIs from various parts of the world tomorrow, worth throwing into the mix. That is it for Early Edition. Surveillance is ahead. We'll be hearing, as Matt was saying, from Blackstone President and COO John Gray. He'll be talking to the team 8:30 a.m. Eastern Time. This is Bloomberg.